Hello and welcome everyone, and thank you for joining this Akhund Forbes webinar in collaboration with Paklaunch. You're all very well aware of Paklaunch, so I won't need to introduce them. I'm Rabeel Akhund, and to discuss our topic today about Nasdaq and Euroclear listings for high growth companies, I have the pleasure of hosting two very distinguished guests from different backgrounds. First, I would like to introduce Mr. Peter Castellon. Peter is a partner at Proskauer Rose in London, where he focuses on offerings of equity securities, including IPOs, follow-ons, and secondary offerings, block trades, rights offerings, and offerings of convertible and exchangeable bonds. Before joining Proskauer, Peter was Deputy General Counsel for Citibank and advised the equity capital markets division and investment banking division. As a result, he brings with him a unique perspective on capital markets transactions. We also have with us Mr. Rabeel Warraich, who is the founder and CEO of Sarmayacar, well known to all of us at Paklaunch and also in the Pakistani venture capital circuit. He is an early stage venture capital fund. Sarmayacar is an early stage venture capital fund dedicated to Pakistani startups. Their impressive portfolio includes household startup names like Jugnu, Jiye Technologies, Abhi, Bykea, Revolving Games, Simpaisa, and a number of others. I hope this webinar, which combines both technical legal expertise and practical commercial insights, will be helpful. So let's start with Peter first. Peter, before we dive into the details of the details and regulations around listings, what are some of the reasons why high growth companies would consider IPOs or listings?
Well, the main reason is to raise capital. And so rather than doing another venture capital round, you would raise capital from institutional investors. And for a Nasdaq IPO, that really is the way to do it. It's not a requirement, but the practice is that it would be all primary, is a general idea for a Nasdaq IPO. So the company is doing it to raise capital for whatever the next stage of its growth is. And then once it's listed, we'll have the opportunity to raise more capital from investors. If you're thinking about going to Euronext, for Euronext IPOs, sometimes the additional reason of doing an IPO is to give the previous investors an exit opportunity. And so, unlike Nasdaq, for Euronext, it is common at IPOs for existing investors to sell. And so an IPO is an exit opportunity.
And Rabeel, so as an investor yourself, how excited are you about any of your companies who might be approaching or nearing an exit? And where would you like to consider any of your portfolio companies sort of listing?
Yeah, thank you, Rabeel. As Peter mentioned, this is another avenue for raising capital, and the space that we are in, venture capital, we ourselves as investors are also looking for an avenue to exit at some point. Those exits will typically either be trade sales, like a larger company acquiring the business, or a listing, which are like typically in the West, in more developed markets, the preferred route to go by. And while at the time of listing, as Peter mentioned, Nasdaq is not generally the preferred route for investors to be getting out. Once the company is listed, it provides us an avenue after a certain lockup period to be able to exit the position that we have. Now, sitting in Pakistan, we of course have local markets here as well, and the considerations around specific exchanges make a difference in terms of where a company can potentially list. In the US or even in Europe, there is a little bit of a longer history of early stage, high growth companies. Once they reach a certain scale and stage, there's a precedence of them listing there. There's liquidity in the markets over there. There's familiarity of investors with such companies. So generally, the companies that do fulfill the requirement, they are able to achieve, in most cases, a successful IPO. In Pakistan, we haven't had that in the past. And while there is some hope that in the future our local exchanges also offer that avenue, we are not yet relying on any of our portfolio companies being able to list locally and achieve the kind of valuations and returns that we're looking for, given the levels at which we invested and back when we did. So some companies in our portfolio have reached a stage that they can now start thinking about this. There are various considerations that we will probably get into as part of the seminar in terms of how one is to prepare a company to go for a listing. But our primary interest is to explore all avenues that are available to our portfolio companies to reach that point of an eventual sale or a listing, and hence we're here discussing this.
Okay, that's really good. So we're getting some interesting questions already, but I'll wait till a little bit further on in the webinar. So Peter, how would and just before I go to Peter, I just want to sort of supplement what Rabeel you just said. Your companies are not designed in that way either, right? Because you've got a Topco and you've got an Opco, you've got a Holdco offshore, and so you are right at the outset. You are thinking of an offshore listing for the Holdco for the reasons that you've mentioned. So, Peter, over to you now. So, what kinds of things do companies need to be prepared for in order to list at Nasdaq? And frankly, what's the choice of a Topco? What choice would you recommend, and what would you not recommend?
So as far as a choice of a Topco, Nasdaq and Euronext are both fairly agnostic. And so both exchanges welcome foreign companies. And so if you choose Dubai or Abu Dhabi or the Netherlands, all of those are fine for either exchange. And so the choice of top company is not a particular concern for choosing a venue. If you choose the Netherlands as your top company, it might be marginally easier to list on Euronext, but that shouldn't be a deciding factor. Do not, however, fall into the trap of thinking we want to go to Nasdaq, therefore we'll incorporate our top company in Delaware. So that is a very logical way of thinking. However, because Nasdaq and the US regulator are very open to non-US companies, the listing requirements are more lenient for non-US companies. So it will be easier for an Abu Dhabi or Dubai or Netherlands top company to list on Nasdaq than a Delaware company to list on Nasdaq. So a Delaware company as a domestic US company will need to comply with US GAAP and will need to do quarterly reporting. There'll be more disclosure in terms of compensation of directors and officers. And so it's a little bit more challenging for a domestic company. Whereas if it's a non-US company, you can continue to report in IFRS. There'll be less disclosure on compensation. And once you're listed, you don't need to file quarterly. It's a more relaxed disclosure regime for listed companies that are non-US than for US companies. So while any top company is fine for both exchanges, I do emphasize think twice before incorporating your top company in Delaware.
And the fact of the matter is that we do have a number of companies that I've seen, at least, where the Topcos are incorporated in Delaware, perhaps for the reasons that for the wrong reasons that you've mentioned. So that's one thing to avoid, particularly if you're looking to list.
And one thing to keep in mind is if you're incorporated in Delaware, you won't be able to list outside the United States. So the SEC has put in place measures to make it complicated for American companies to list outside the United States. There are a few, just a handful, that are on the Toronto Stock Exchange, and there are, I think, 17 on AIM here in London. But the trading restrictions that are imposed upon them under the US rules are fairly severe. such that you know, an American company thinking of listing outside the United States, that would be a challenge. So if you incorporate in Delaware, you're doing two things. You're locking in Nasdaq, but also you're locking in a more challenging version of Nasdaq.
Interesting. Very interesting. So what is the process that a company would have to go through, particularly a company like a Pakistani company with VC funding in the Topco, with an OpCo in Pakistan, business in Pakistan? What are the steps they would have to go through to achieve a listing on Nasdaq or Euroclear?
Sure. So the process, you know, you should budget, say 6 months from kickoff to listing, and you have to prepare a prospectus. The prospectus, of course, will contain financial statements, will contain narrative description of the financials. So what Americans call MD&A, Management Discussion Analysis, what in Europe is called an OFR, the Operating and Financial Review. And then they'll contain risk factors. So you do have to not only put the positives, you also have to spell out the risks in your prospectus. So that, you know, will generally take 2 months to prepare, and then you file it with the appropriate regulator, either the SEC in the United States or the AFM in the Netherlands. The gating item for all of this is the financial statements. So if you're thinking of going public, definitely speak to lawyers right away. But sadly, even more important is to speak to your accountants and see what needs to be done to have financial statements ready to go public. And so clearly for Euronext, the financial statements have to be in IFRS, and that's fairly straightforward. For the United States, it's also IFRS. So a Delaware company has to do US GAAP, but a non-US company also does IFRS. So from that point, it's straightforward. However, they need to be audited to American auditing standards. So it's still IFRS, but it's US GAS, GAA, sometimes referred to as PCAOB standards. And so what that means is, you know, you have your financial statements audited by your regular accountants in IFRS, and then within the same accounting firm, a US qualified auditor will more or less redo them. They don't use that terminology, but it's all the same redone. And so that's why I say that it's crucial, as far as from a timing perspective, to speak to your accountants right away, see how long it will take them to have IFRS statements under US standards. And for some companies, that's very straightforward, and it's not going to be a challenge. It's just, you know, a month, 6 weeks, 2 months worth of finding an American accountant to do it, and it's all fine. And you can work that into the timetable. There are some companies where, because of their circumstances, it might be more challenging if they have, say, discontinued operations, or if they have strange or exotic financial instruments as part of their balance sheet. It might take a bit longer. But for a lot of companies, that isn't a problem. It needs to be addressed right away, very first thing, so that you can work it into the timetable. But it's not a problem. But so that's priority number one. The preparation of the prospectus, you know, probably takes a month, 6 weeks, 2 months, depending on how challenging the disclosure is. But for a typical company, you know, 2 months is a comfortable amount of time. Then you file with the regulator. The SEC takes 30 calendar days to respond. The Dutch regulator takes 20 business days, so it's about the same. And then, you know, you get their comments. Both regulators have a practice of giving all their comments up front. And so any subsequent comments will either be because of new disclosure or the passage of time. But for both regulators, you will not get surprise comments on the second and third round. There are some other regulators, for example, the regulator here in England, the FCA, that will have a new reviewer on the second round, and you might get completely new comments. That is not the case with the SEC or the AFM. And then otherwise, once you go through that process, incorporate their comments, then you list. And, ideally you will have had, not ideally, you will have had an underwriter, some financial institution that will find investors. There will typically be a roadshow as part of that. These days, the roadshow is mostly virtual, not entirely, but mostly virtual. There's pre-marketing that's done, and so the banks typically on both sides of the Atlantic now will go to institutional investors to get a sense of their interest before the IPO is publicly announced. In Amsterdam, your underwriter will also prepare pre-deal research, and so there will be a research piece that goes out as part of the IPO process. That is not the case for Nasdaq deals. There is no pre-deal research. Other things that you have to consider is for Nasdaq, there is, in addition to the process with the regulator and getting the prospectus reviewed and cleared, you also have to file an application with Nasdaq, and that's a separate process. And it's all doable within the timetable, but it is an additional process. So it is almost like you are applying to two regulators. And in fact, there's a third regulator, FINRA, which regulates investment banks in the United States. The investment banks will do their own filing with FINRA, which is a third filing. And FINRA, their mandate is to review what the banks are doing with the goal of making sure that they don't charge excessive compensation. Americans, of course, have a higher definition of excessive than Europeans, and so customary underwriting commission for Nasdaq is 7%, which is a bit higher than it is for Euronext. And so that's the process. If you're going to Nasdaq, you might consider doing ADRs, American Depositary Receipts. You, of course, would not do that if your Topco is an American company. You typically would not do it if your Topco is a Dutch company. So Dutch companies list ordinary shares on Nasdaq. But if it's anywhere else, you would probably get American Depositary Receipts, and you'd appoint a depositary bank, and that depositary bank would issue the ADRs. They would take the shares, issue the ADRs. That's what would trade in Nasdaq, and that depositary bank would also act as a registrar. So you wouldn't appoint a separate registrar.
Thank you. That's very, very detailed run through. So before I come to you, Rabeel, I just want to sort of give the Pakistani perspective on the prospectus. So we do have the same risk factors. We have to make the disclosures, but our risk factors, I'm sad to say, are fairly standard. So when you say that you take about 2 months for the MDMA and the due diligence, the verification, and the risk factors, they have to be tailored to that particular business, to that particular industry. I mean, it's a bit of a generalization, which I don't want to be held to, but usually the risk factors in a Pakistani prospectus are fairly repetitive, right? And the market here needs to be aware of, and the SECP is now becoming more and more proactive and becoming a lot more vigilant now on the kind of content that goes into prospectuses. But a few years ago, it was a fairly formulaic exercise, which as someone capital markets practitioner, I think is the wrong thing to do, because it doesn't protect the investor properly. But Rabeel, Peter mentioned accounts, the financial reporting. Yeah. Are Pakistani VC funded startups, Series A, Series B investee companies, not just startups, but sort of early stage and mid-stage companies, are they prepared? What is their financial reporting like?
Yeah, that's a great question. And I also want to just build on what Peter shared. While the process itself might be 6 months, Pakistani companies in particular need to start thinking about it years in advance. I would say at least a couple of years, because there's a few things that you need to do in addition to having strong, accurate, and audited financial statements. You need to enhance your corporate governance. You need to invest in the systems, both for reporting purposes, but also for compliance purposes. You need to, in most cases, do investor reach out already, build those relationships. You need to engage advisors quite early on to be able to guide you around the full process as well. And just generally adopt best practices that can position you to not just list, but also then be able to comply with what are fairly stringent requirements, including from the SEC in the US. Most of the companies that we invest in initially typically will not have these in place. And part of our responsibility is to get them up that learning curve of what to put in place when. We often say that an independent board is often a very, almost a requirement for a company to list. But when a company is raising a seed round, there is no board. And sometimes even Series A companies will not have that, or initial early investors might be on the board. But over time, you need to both incorporate some of those best practices, but also bring on industry experts and be able to position the company effectively in the market in which you are looking to list, because those investors are going to expect that. And while we try with our own internal reporting, which we require startups to report to us, which we then report to our LPs, they are still not at the level that a listed company is expected to have. So it's a process. There's no easy fix to it. And so the mindset needs to be adopted, which really positions you to effectively list the company, but be able to then comply with all the requirements, which are fairly stringent. So I just don't want to anyone to walk away thinking that okay, just going through the process means that there's going to be a successful listing. I think there's a lot of work that needs to take place before that as well.
And on that, Rabeel, so there's a very interesting question which has just been raised. I'll put that to you, and then I'd like Peter's perspective on this as well. So the question is, the process is good to know, but the main focus should be on raising capital, which is correct. And how do you attract good institutional investors? And what sort of valuations can we expect given the perceived risks of the Pakistani economy? And how do you go around getting good investors interested?
Sure. I think strong performance by itself is the biggest indicator of a strong company. And if financial performance is good and it is reported in the right way, and an active effort is made to network with investors, not just from within the country, but to go on roadshows, to participate in conferences and investor events, or in the market in which you're looking to invest, that over time builds the kind of confidence and comfort that is required from investors to be looking at a company which has underlying operations in Pakistan. Now, if you are living with that reality that your underlying operations are Pakistan, there are certain risks that you just have to manage, that you're exposed to. There is, of course, FX risk, meaning underlying operations being in Pakistan means that highly likely you're generating your revenue in PKR. So there is this FX risk. There is a lack of maturity in the local market, which you see in some other markets, which investors are going to put a bit of a risk premium on. There are, again, then macro considerations tied to individual countries or jurisdictions, which also need to be taken into account. For Pakistan, there's also this additional, at least a perception that it's difficult to get capital, even from your OpCo up to upstream to the HoldCo, because ultimately, if the HoldCo is getting listed, that is where the financials need to flow, and that's the basis on which your company will be valued. So while a like-for-like performer compared to a company in Silicon Valley, a Pakistani company, if the performance is exactly the same, I would still expect there to be a meaningful discount applied to the company in Pakistan because of some of these aforementioned risks. However, ultimately, if you have high growth, if you have strong margins, if you show the kind of operational performance that these investors have grown used to seeing from the companies that they have listed previously, there's no reason why you shouldn't be able to list. However, do expect there to be a discount on the valuation that you're able to achieve, and maybe even the amount of capital that you're able to raise from the listing.
Peter?
Yeah, institutional investors will, will look at that and potentially, not pay as much as they would for a Silicon Valley company. So I agree with that. I just got a question. I think it was to me only. And the question was, do you need independent directors? And so the answer is yes, you need independent directors. For Nasdaq, a non-US company listing on Nasdaq needs 3 independent directors for the audit committee. One of those 3 must be a financial expert, so either an accountant or previously have been a CEO or a CFO of a public company, or some other, or maybe have been an investment banker, some way of establishing that one is a financial expert. He or she must be independent, and there must be 2 further independent directors. So that's the minimum, 3 independent directors. If you have a board of 6 or less, then one of the independent directors must be a minority or a woman. If it's more than 6, then 2 must be either a minority or a woman, but 3 independent directors.
And Peter, there's on that note, there's another question, which is on Euronext, can you use local GAAP if you're looking to, they're saying you can use local GAAP if you're looking to list on the Euronext growth market. You don't necessarily need to do a conversion exercise to IFRS.
Not correct. So in Euronext Amsterdam, there is no local growth market. It's just the one exchange that does growth and non-growth. And so you have to have IFRS. You cannot do Dutch GAAP to list on Euronext Amsterdam. We're not talking about AIM on this one, but if you have an English top company, I'm not sure there's a logic to that, but if you had an English top company going to AIM, you could use UK GAAP rather than IFRS. So that's definitely true. I would say just go straight to IFRS and don't bother with local GAAP. But certainly for Euronext Amsterdam, it has to be IFRS.
Okay, that's good to know. And what about profitability? Is there a requirement for the company to be profitable? Because of Pakistan, the main exchange there is. But for Nasdaq and Euronext?
Nope. As long as you disclose the financial situation, they don't have to be. They can be pre-revenue. There is an argument, of course, that maybe you should be approaching that revenue if you're not yet if you're still pre-revenue. But that's I'd say that's a marketing question rather than a requirement.
And Rabeel, how far do you think we are in any of the leading Pakistani startups sort of thinking about or preparing themselves for a Nasdaq listing or a Euroclear listing?
Yeah, I think frank answer is we are still some distance apart from being at that point. There was a recent listing of a underlying Pakistani company. I think it was called something like Gamer Pakistan, which is about like 6 million or so. And that was more an exception than what you would typically see. And they were able to raise while they're not profitable, and they raised that capital to be developing what they want to be developing, more of an esports offering. The example I would want to share with audiences is Jumia, which was an e-commerce company out of Nigeria. which listed in Nasdaq on Nasdaq in 2019. That was maybe an example of like, the kind of scale that you're looking for when you get to that point. And by then they had raised multiple rounds before, and performance since then has not been great. So again, like, keeping performance elements aside, we as an ecosystem need to mature still quite a bit. We need to get to those levels, those same standards that are expected. Performance-wise, while there might be a couple of startups that we can point to which are doing well and have shown sustained growth over the last few years, the current dip in financing available to them is impacting their chances of getting listed, right? Like, so the moment you see a bit of a blip, the time frame for a listing gets pushed out by a couple of years easily. And we're likely to see more from maybe potentially the Middle East region get to that point first. We've already seen a SPAC listing. A SPAC, for the benefit of the audience, is a special purpose acquisition vehicle, where Queen's Gambit merged with Swivel, and Swivel ended up listing. Unfortunately, Swivel's performance in the stock market after that absolutely tanked, which was again reflective of like, the overall company's performance. But they had to go through those steps to be able to list. And from our perspective, looking at our own portfolio, or more generally the Pakistan portfolio of some of the VCs that are focused here, I think we're at least a couple of years away from the first one. But when the first one happens, then hopefully it will open up the doors for others to consider. And for the ones that we do think they have a shot, we're already encouraging them to put in place some of the things that Peter mentioned earlier, and also potentially explore expanding to other markets so that there's some sort of revenue diversification, so you can mitigate some of the risks that I highlighted earlier.
Peter, on SPACs, you want to talk about that?
On SPACs. So what I've been saying so far is IPOs. You can be acquired by a SPAC, a special purpose acquisition company. So that's a company that is already listed on Nasdaq or Euronext. And the purpose of that company is to acquire a private company and take that public. The supposed benefits of a SPAC is that it's a quicker process for the company, the operating company, in theory, and there's more certainty because you agree a price up front rather than agree a price at the end of a book building process 3 days before you're going to list, is the theory. As a practical matter, it is not a faster process on Nasdaq. Because of US tax rules, the operating company acquires the SPAC, not in the classic structure of the SPAC acquiring the target company, which is the case for domestic US companies. But if it's a non-US company with a Nasdaq SPAC, it's the non-US company that acquires the SPAC. And so that means that it's that company that has to list rather than relying on the existing listing of the SPAC. So as a practical matter, you don't save any time, don't save any energy, any process if you're a non-US company being acquired by a Nasdaq SPAC. If you're being acquired by a Euronext SPAC, there is a time saving. So if it's a Euronext SPAC, then it is the SPAC that acquires the operating company in the classic structure. It is quicker. You still need, to have financial statements. You still have to be prepared to be a listed company, on the day that the transaction closes. But from a process point of view, it is a much faster process.
You're on mute,
Sorry,
Rabel.
Yeah. So now, in terms of the ongoing burdens, so we've talked about reporting. You've said Nasdaq reporting isn't too bad, but what are those ongoing responsibilities, and what are the difference between Nasdaq and Euronext?
So a Nasdaq company has to do an annual report every year within 4 months of the end of the financial year for non-US companies. And that annual report is a new prospectus. So the requirements for that are absolutely the same as for a prospectus. So you have to do an updated, you have to update your MD&A, your OFR annually. And so that's not easy. You have to have all your disclosure updated annually. And then otherwise, you have to do anything that's material that you put public, in your home market or anywhere in the world, you have to submit that to the SEC, and it goes on the SEC website. So most companies, most non-US companies, will submit all of their press releases and any shareholder circulars, anything to do with shareholder meetings. All of that is furnished to the SEC. And you have to do interim financial statements at the 6-month mark. So those interim financial statements are a Nasdaq requirement, not an SEC requirement. So the SEC requirement is once a year. Nasdaq is twice a year. The interim 6 months numbers do not need to be audited, but of course they'll be reviewed by the accountants. And then the CFO, CEO have to certify annually to the financial statements. For Euronext, it's more or less the same, an annual report. Ideally, the annual report would be written to a prospectus standard, but as a practical matter on Euronext, that isn't always the case. And then anything that is material, any material developments of the company, you have to do a press release. The US requirements are not anytime there's a material development, you have to do a press release. It's anytime there's a press release, you have to submit it. For Euronext, it's anytime there's a material development, you have to make that public. And so that, of course, is an ongoing process. And for Euronext, it's also, you have to do interim financial statements at the 6-month mark. That's different for domestic US companies that have to do quarterly financials. For non-US companies, it's at the 6-month mark.
But that can be quite expensive then. So what are the costs? What sort of costs are we looking at for a Nasdaq listing as opposed to a Euroclear listing? You mentioned 7%, but generally for advisors, costs, what are the one-time costs, and then the ongoing costs or something like that? Would you have an idea of that?
Yeah, so Nasdaq is a lot more expensive than Euronext. There's no hiding that. So the underwriters will charge you 7%, whereas Euronext it's 4 to 5%, and it's kind of negotiable on Euronext. It's not negotiable on Nasdaq. It's 7%. The lawyers, American lawyers doing a Nasdaq deal, it's $1.5 million, possibly $1.8 million for the issuer's lawyers. For Euronext, it's about half that. But for Euronext deals, sometimes the issuers also pay for the underwriter's lawyers. That's not typically the case for Nasdaq. The accountants will charge more for Nasdaq. So as I mentioned, if you go to Euronext, it's IFRS, and that's fine. If you go to Nasdaq, it's also IFRS, but it has to be done to US accounting standards, still IFRS, but US GAAS, not GAAP, GAAS, GAAS.
Yes.
And so in effect, you're paying the accountants twice, in effect. And they're also going to charge more because there's greater liability in supporting the financial statements in the United States. So accounting will be more expensive for Nasdaq. The counter argument is, well, sure, but the opportunity for appreciation is greater in Nasdaq than it is in Euronext. And the argument is, in the end, you'll do better. You'll have higher upfront costs, but you'll do better long term is the argument. But definitely higher upfront costs.
Well, that brings me to you, Rabeel. With such a large price tag, the valuation of the target company in Pakistan, or at least the intended raise, should be substantial to justify these costs, don't you think?
Absolutely. I think that's why, like, before one can even begin to consider listing on either of these exchanges, the company needs to be in a financial standing that they can both withstand these kind of costs, but also hopefully garner the kind of valuation that will make a return for both early investors, but also founders and team members that have built the company. There's also a lot of costs that you incur even before you get to list, right? Like, so you need to have sufficient cash runway available. You need to engage advisors in some cases, like quite fairly early on. I'm speaking to two lawyers here, so they'll never admit that they're quite pricey, but a lot of times you need to, like, factor all of that in on top of what is just the general operating costs of the business. So absolutely spot on. It's a very serious consideration, and that's why perhaps that's why not many companies have been able to list from Pakistan in the past.
That's true. And on that price thing, I should just clarify that lawyers, particularly in these sorts of listings, they're taking a risk as well, right? They're taking a risk because of their work and their due diligence, the work they do on the prospectus is not accurate. They're themselves taking a risk. So in order to discharge their duty, they've got to do a really, really good job, a really thorough job, and that is where it becomes expensive. A lot of people don't realize.
Rabel, that's especially the case for Nasdaq, because when you file with the SEC, the lawyer's name is on the front cover of the filing that's publicly available on the SEC website. So it's both the lawyer representing the company and the lawyer representing the underwriters. Their personal name, not just their firm, the individual partner's name for those two goes on the front cover.
Yeah, so you're putting your own not just reputation, but your own livelihood on stake.
Yeah.
So just switching a little bit from VCs and startups. What about some of I mean, we have some fantastic companies on the Pakistan Stock Exchange, Systems Limited being one of them, high growth tech. What about some of the listed companies in Pakistan considering a dual listing or a cross listing on Nasdaq? Peter, how would that work?
So that is actually even more straightforward. So you don't need, if you're already listed in your home market, you do not need to have underwriters. It might make sense to have a financial advisor anyway, but it's not required. So you file a registration statement with the SEC, and your listing application with Nasdaq. You do need for the financial statements, and you do need to have the MD&A. It looks like a prospectus. It's not a prospectus. It's a registration statement, but it has all the same information. But as long as you meet the free float requirements based on your home listing, you'll be okay with listing on Nasdaq. You don't need to have an additional Nasdaq free float requirement. So it is global, and so the Nasdaq very much welcomes that. The SEC welcomes that, and there are quite a few examples in recent months of European companies getting a second listing on Nasdaq without doing any fundraising. So that's doable. You can also do an IPO and get do a fundraising as part of it with underwriters. If you do that, it'll be the 7% charge of the underwriters, and they'll be more involved in the process. But that is also doable. But I should also mention, even if you're listed on your home exchange only, or if you're listed on Euronext, you can still attract American investors. So the rule is Rule 144A, which allows very sophisticated institutional investors. So they're called QIBs, qualified institutional buyers. They have more than $100 million in securities as part of, say, a fundraising for a company listed in Pakistan only, or a company listed in Euronext. You can go to QIBs. Listing in Nasdaq is not the only way to attract American investors. If you list in Nasdaq, you can go to, say, American retail. But if you list on your home exchange or list in Euronext, you can go to institutional investors. And so that is possible.
That's good, because and I dare to say that I have a feeling that we might see some of those sorts of structures appearing on Nasdaq first, before we get the startups and the VCs and the early stage high growth companies sort of listing there. But you know, and that just sort of because there has been an example, and Peter, you just mentioned the Reg S Rule 144A type of offering. So Pakistan has had a very successful track record of offering secondary offerings, at least. The Privatization Commission, the government of Pakistan did a very, very successful secondary offering of its own shares. It wasn't an IPO, it was its own shares in Habib Bank Limited, which raised about $1 billion, which was the largest one that I had the honor of being involved in. But it's, you know, the markets are different now, and somebody's just raised a question about, you know, repatriability issues. So yes, Pakistan does have repatriability issues, but they're not legal issues. So you've got to distinguish between two things. You've got if the shares of the international or the overseas shareholder are registered with the SECP, if they're a private company, or if they've been bought through a certain approved channel for investment in listed companies, those shares are held on a repatriable basis legally. So if you have issues surrounding, and which we have had in the last couple of years because of a severe shortage of foreign exchange, if you have issues surrounding repatriation of dividends from listed companies even, that is not a legal hurdle. That is a commercial issue. And for something like that, if you make the right disclosure that yes, Pakistan has had these issues, and it may do again in the future, and people priced in, then that should not be something that stops secondary offerings, IPOs, listings or dual listings across systems. Peter, would you agree with that?
Yeah. Yeah. So
international
investors, if I understand the question correctly, international investors won't have repatriation issues.
They won't legally, they won't have repatriation issues. But if they do, so in the what's happened in the last couple of years is because there was a crunch on foreign exchange, legally they were entitled to take money out, but the government or the state bank delayed those dividend repatriations and they got stuck. So it was more of a currency crunch rather than a legal hurdle. And that's something that will now have to be disclosed in every future public offering.
Yes.
It's a risk factor. And in fact, even when we did the HBL secondary offering, we did say it was a risk factor that we had mentioned. So it's something that people price in. And you know, I personally believe that capital markets have a very short memory. You start doing well and people will start flocking in. Yeah. So we've just come up to 10 minutes to 10 here locally in Pakistan. We've been talking for about 50 minutes. I think it'd be a nice time to pause and give people an opportunity to ask any questions or any other thoughts that you may have.
There's this one question, Rabeel, maybe Peter can address that, which is around a secondary listing, whether it's a requirement to raise capital as part of that.
No, it is not a requirement to raise capital. So if you're already listed and you go to Nasdaq, you do not need to raise new capital as part of that, and your free float in your home market will be counted as your free float for Nasdaq. You don't have to have separate free floats. And as I was saying earlier, there are recently it's become very trendy for European companies to get a second listing on Nasdaq. So there's quite a few recent precedents of that.
And just to follow on, this is actually a question that I have. Are there any minimum market capitalization requirements to stay listed on either of these exchanges?
Yes. So the free float requirement in Euronext, in theory, is 25%. So 25% of the shares must be in public hands. However, the regulator is very accommodating in granting waivers to that. And so as a practical matter, you can comfortably go down to 10%. That is very likely to be waived. But they have been known to go lower. On Nasdaq, the free float requirements are slightly different. It's 300 shareholders. So it's not a percentage, it's an absolute number. So 300 shareholders who hold 100 shares each, and at least 1 million shares outstanding. So that's the free float requirement for Nasdaq, 300 shareholders who hold 100 shares each. So when you do your IPO on Nasdaq, the underwriters will make sure that you have 300 shareholders with 100 shares each. And at least, the other requirement is just a corporate requirement. Make sure that however you do it, you have 1 million shares. So this is kind of an interesting issue of in Europe, free float is a percentage. In the United States, free float is an absolute number. And so this won't be relevant here, but for much larger companies, they will list on Nasdaq with a very small free float as a percentage. Whereas, if you list on the Frankfurt Stock Exchange or the London Stock Exchange, where the regulators are less accommodating than the Dutch regulator, 25% is a high free float to get on an IPO. But the good news is Euronext is the regulator is more flexible, and so you can get a waiver for 10%.
We have another one.
No. What I was saying, if you meet that requirement in your home market, so if you have 300 shareholders who hold 100 shares each, that is sufficient for getting a listing on Nasdaq.
Peter, there's another question saying, for secondary listing, raising capital is not a requirement. How much would an investment bank cost for a technical listing? I suspect the answer is about the same, right? Even for a technical listing, the costs are the same?
So if you're just doing a secondary listing, you're not raising capital, you don't need to appoint a financial advisor. You don't need an underwriter. And so if you want a financial advisor to help you along, that certainly is not a bad idea, but they will not charge you 7%. It'll be an agreed fee that there's some give and take, and you can shop around. If you're doing an IPO, there's no shopping around. It's 7% for everybody. So 7% is a ceiling imposed by the regulator, which immediately also became a floor. But if you're just getting a second listing, not raising capital, you don't need a financial advisor. And so there are some companies, some European companies recently that just did it. They had their lawyers and their accountants, but they didn't have a financial advisor. But if you do have one, they'll be far more accommodating on fees. And you don't need to have a big bank. You could get an equity advisor, a boutique that'll be just as good as a bulge bracket bank as far as being a financial advisor for a listing only.
And what sort of European companies are listing on Nasdaq? What industry sectors are they in?
So recently, companies that have gone. So there was a Spanish company, Ferrovial. They're a construction company, and
Quite
so
large.
they're fairly large. They went to Nasdaq as a second listing, no raising of capital. There was an Irish company called Flutter. They went to Nasdaq, no raising of capital. They're a betting company. They own the Paddy Power betting shops. And then there's a building materials company called CRH, and they did the same thing. They went to Nasdaq with no offering, just a listing.
Interesting. And what would be the reason to do that? Greater transparency, regularly? Why would they want to do that?
So for them, for some of them, if you have U.S. operations, it's sensible to go to Nasdaq. The theory goes, but also if most of your comparable companies are American and are listed on Nasdaq, the argument would be that you could get a better valuation on Nasdaq because that's where your comparables are. Then there's some companies that think if you're in some kind of technology sector, that American investors are better able to value technology or biotech than the European investors. And so some companies are doing it for that reason. Now, I think some underwriters, some investment banks would say, yes, that's true, and that's why you should do your IPO on Nasdaq. But once you're listed on your home market, you have to think twice about doing a secondary listing because there's an issue of, do you split your liquidity? Is it additional liquidity, or is it going to be a split of liquidity? And I've certainly seen investment bankers go both ways. That's specific to the company, but that is something you definitely have to consider. And it seems like the current trend is you don't split liquidity, you get additional liquidity with the second listing. Seems to be the current thinking.
Yeah, no, that's my perception as well, that actually you just end up getting additional liquidity. You don't split it, you don't cannibalize it. It's just additional liquidity. Great. Well, we're right up to the end of the hour at 10 p.m. Pakistan time, 6 o'clock London time. Peter, Rabeel, thank you very much for this really informative, knowledgeable, exciting session. I'm sure everyone in the audience learned a lot. And thank you so much for giving us your time and being here with us today. Thank you, Peter. Thank you, Rabeel. Thank you.
Pleasure.
Thank you. And thank you, Ali, for hosting us. And thank you to the Paklaunch team for organizing this. Okay.
Thank you, Rabeel.
And thank you, everyone, for joining and taking out your evening and sort of giving a part of the World Cup. So thank you, everyone, for joining. Bye-bye.